now are 4 components to the forecasting process. The first one is to input historical data. Now, this may be published, it may be publicly available, or alternatively, it may be private and provided to you by the management of the company you're looking at. This leads us very nicely into the second component. We will build ratios and statistics based on the historical data. So, for instance, we may have a couple of years of historical sales, and we see that sales have been growing by 5% every period. That would be my ratio or statistic, the 5% increase. This means that I can now go looking for key links or performance drivers between some of the numbers. That links very nicely into the third component, which is making future assumptions. If I've seen that my historical sales have gone up by 5% every period, I may assume that my future sales will go up by 5% as well. So history is the first place to look for your future assumptions, but you may find other inputs as well. You may have some industry research, which you think is going to impact on your company. You've now got 5% being your assumption for the future increase in sales. You now just need to actually forecast that sales figure. So if last year's sales were 100, step 4 would say that this year's sales would be 105. Our first design choice is what to do with our assumptions. Do we block them together or do we put them throughout the model? In the top part of our table here, we've got them blocked. So revenue growth assumptions, operating cost assumptions and taxes assumptions are all together. Now the benefit of putting them all together is that it's more user-friendly. I can never forget where they all are because they're all in one place. Particularly in a big model, you might have them all on one tab. Blocked assumptions thus are particularly important in bigger models. If we look at the bottom part of the table though, I can see revenue growth assumptions here, 3%, and then I can see the output, revenues, 404.1. So I've got the driver, the 3%, and the output together. The benefit here is that your output and driver are being visible together, and so I can see what is actually driving my output. So we've got a difference here between blocked assumptions and throughout or threaded assumptions. My next design choice is whether to have costs shown as positives or negatives. In the top half of this table, we can see 2 costs, operating costs and tax expense. Now, they've both been shown as positives. Decide yourself, do you find that user-friendly or not? We often find that negative presentation, where those operating costs and tax expenses are shown as negatives, makes it easier to sense check our work and makes more sense when it's printed out. Also, it's easier to have negative presentation if your operating profits were a sum function. So the 20.8 in this table can just be a sum of the 2 items above, the revenue 416.2 and the 395.4 operating costs, if the operating costs was shown as a negative. But what if it's a positive? Well, you couldn't use the sum function. You'd have to do revenue minus operating costs. One thing to watch out for with negative presentation is that the sign might be flipped on some formulas. So going back to operating profits, if you wanted to take your revenues and then subtract your negative shown operating costs, well, you'd have to take revenues plus operating costs or sum them up. So do be careful, you do often have to flip the sign on many formulas when showing costs as negatives. Our last design choice is deciding whether our model is going to be a one-tab model or a multi-tab model. A one-tab model would have all of your major items, income statement, balance sheet, cash flow statements, all on the same tab. And you could even have your assumptions, your calculations, everything all on that one tab. This is pretty useful for smaller models, and it means when you're importing links to new files, it's going to be easier. You just take one tab and put it in there. A DCF, discounted cash flow, is a good example of where we often see this. A multi-tab model would have one tab for your income statement, another tab for your balance sheet, another tab for your cash flow statement. This is particularly good for bigger models. However, cross-sheet links will exist between those two tabs. For instance, your income statement links to your balance sheet, which links to your cash flow statement, and this can use up more memory. So do be aware it's going to be a larger file size and it's going to run that little bit slower. We often see this on LevFin, i.e. leveraged finance models. Let's look at how the three financial statements integrate together. We start here with the cash flow statement. The cash flow statement gives me loads of detail of cash going in and out of the business. Here we've got some cash coming in, so maybe some customers have paid their bills. And we've got cash going out. Maybe we've paid some suppliers. So that gives me the net cash flow for the year, and there will be many more lines in this in a real cash flow statement. It gives me lots of detail and it helps me explain the change in cash on the balance sheet. So I may have a balance sheet from a year ago with cash of 100, and I may have a balance sheet now with cash of 120. I can see the cash has changed by 20, but if I want the detail, the cash flow statement gives that to me. But a balance sheet isn't just made up of cash in its assets, it's also made up of liabilities and in particular equity. We can find out more detail on equity via another financial statement, being the income statement. If I look at retained earnings within equity, I can see that it's maybe gone up from, say, 70 to 90. Cool, it's gone up by 20, but I want more detail on why that's happened. And the income statement shows me that information because retained earnings shows accumulated profits not paid out as dividends. And where do we find the profit for each year? On the income statement. So here's my income statement. Let's assume that the profit was 20 and we had no dividends. That would explain why the retained earnings went up by 20 from 70 to 90. I want to delve into the detail. I want to find out why we earned a profit of 20. That's going to come from your sales minus your expenses. I could look into what made up my sales and what made up my expenses. I could even compare it to previous years and judge how well the business is doing. So the three financial statements do come together and give us a broad view of how business is performing. In Simple Model 1A, we're going to build an income statement and balance sheet for the forecast period. What we've got provided to us already is some historical figures in the income statement. From them, we've built some ratios and statistics, and they've helped us come up with our forecast assumptions into the future. And then eventually we'll use them to come up with our forecast figures. So let's go through that again. That is your forecast process. Number 1, historical figures. Number 2, ratios. Number 3, forecast assumptions. And then 4, financial forecasts. The one thing missing if we look to the historical period is we can't see any subtotals. So I'm going to put some subtotals in here. I'm going to sum up the revenues and costs to get net income. I will do the same in the balance sheet. Sum up total assets, sum up total liabilities, and then sum up total liabilities and equity. Fantastic, they're all working in. I want to make sure that that balances. Total liabilities and equity minus total assets comes to 0. Fantastic. Now I'm going to copy them to the right so the historical figures are all filled in, and I'm actually going to copy them into period 1 as well. I know those formulas are going to be consistent, so let's take them into period 1. Period 1 will all be done. In going through this model, I'm going to do period 1 in full, then I will copy all of period 1 to the right into period 2 and period 3. So let's start with period 1. For revenues, I look up to the assumption and it says it's going to be 5% revenue growth. So I'm going to take 1 plus the 5%. Give me 105%, multiply that by last year's revenue, and that gives me this year's revenue of 110.3. Similar for costs, I look up to the assumption, and what does it say? It says costs as a percentage of revenues, 85% of revenues gives me 93.7. Thus net income auto-completes. The cash assumption is just given to us, 28.4. Inventories go up to your assumption again, and it says it's going to be 13% of costs. So I multiply the 13% by costs of 93.7. So my total assets are 40.5. I really hope that my total liabilities and equity comes up 40.5 as well, and I get a balanced balance sheet. So long-term debt, what's the assumption? It says long-term debt change. Well, there's going to be no change from the previous year, so I will add 0 onto last year's 10. Debt hasn't changed. The last one is equity, and there's no specific assumption given to us for equity. So I now need to ask myself, well, what could go up and down? Well, it could be share issuance or repayment, but right at the top of the model, it said there was going to be no share issuance or repayment. So it's going to be retained earnings within equity. That's going to go up by net income. So I'm going to take my net income from the income statement, 16.5. I will add that onto last year's equity, and that's the only reason it will have increased. I cross my fingers, I hope the balance sheet's going to balance, and it does. Fantastic. So that is period 1 all done. I can now copy period 1 to the right. That will then grab all of the assumptions from period 2, bring them into the period 2 forecast period, and there are all of my figures for period 2 and 3. If I scroll down, again, I can see that the balance sheet does indeed balance for that period. We first need to calculate subtotals for the income statement and balance sheet in the historical periods. So for my net income, I'm going to take revenues minus costs. Correct gives me 40, and I now copy that across into period 0 and into period 1 as well. I don't want to recreate those formulas in period 1. For the balance sheet, I can press Alt equals, I sum up my total assets, copy that to the right. Same for my total liabilities, sum them up, copy to the right. And for my total liabilities and equity, I write the sum formula in manually. I sum up total liabilities and the equity figure. Copy to the right. Let's check that it balances. So I take my total liabilities and equity, subtract the assets. I hope for a 0. Yes, I do get a 0. It balances every period. So I've done all of my historical figures now. I now want to start forecasting period 1. So I press equals, open brackets, 1 plus. Why have I done that? Well, I know that I have revenue growth as my assumption. So 1 plus 5%, multiply that by last year, I'll add 5% onto last year, 5% growth. My costs, if I look at the assumption, is 60% of revenues, net income automatically calculated. Great, I can now copy those to the right. Let's make sure those figures are all correct. 46.3, 48.6, fantastic. I carry on now down to the balance sheet. Now cash I'm going to leave out. There isn't actually an assumption given. What we need to do for cash is calculate the cash flow statement later on. So I start with investments. I scroll up to my assumptions. Assumption is investment growth is 5. So that's 5 added onto last period. And I've gone up to 65. Great. Accounts payable, up to my assumptions. It's going to be 19% of my costs, 66.2, 12.6. And long-term debt, again, up to my assumptions, and it's going to be a 0 increase or decrease on last year. So I add that onto last year's figure. Last up then, equity. Equity, if I think what's going to make that go up and down, it's going to be net income, making it go up. Net income was 44.1. I add that onto last year's equity, and that now gives me equity of 84.1. So having finished my balance sheet, I see that it's unbalanced by 51.7. Disaster. Why is that? Well, if I look up, I can see I still haven't quite done cash. So the next thing we'll have to do is do the cash flow statement and then put the eventual cash at the end of the cash flow statement up into the balance sheet and pray that it balances, but of course it will. To build our forecast cash flow statement, the first question is, in which period are we doing this? Well, I know my balance sheet is unbalanced in period 1, 2 and 3. I therefore only need my cash flow statements in period 1, 2 and 3. I don't need to do historical cash flow statements. So I start with net income. I go up to my income statement, 44.1. Next up, I need to work out the increase or decrease in accounts payable. So if we go to our accounts payable, it's gone from 12 to 12.6. Now, if that's gone up, that means I owe my suppliers more cash. It means I've got their cash. That means my cash has gone up 0.6. Good for me. I need a positive 0.6. In order to get that, I will take this year's accounts payable minus last year's. So liabilities and equity, you take this year minus last year. That gives me my cash flow from operations of 44.7. Next up, we'll look at investments. Increase or decrease in investments. Now, investments have gone up from 60 to 65. But this means I have purchased investments. I've spent money, I've spent 5. So I want a negative 5 in the cash flow statement. So I will take last year minus this year. When it's an asset, you take last year minus this year. When it's liability and equity, the opposite. That's my cash flow from investing activity done. Next up, increase or decrease in long-term debt. Long-term debt has gone from 20 still to 20. So I need to imagine what would have happened if it had gone up. So imagine it had gone up from 20 to 22. That's more cash to me. I want positive 2, so I take this year minus last year. Great. That's my cash flow from financing activities. I now sum those 3 items above up. Cash flow from financing, cash flow from investing, cash flow from operations. It gets my net cash flow of 39.7. Now onto that, I need to add beginning cash. I'm actually going to take last year's ending cash first of all. I go to my balance sheet and that was 12. Last year's ending cash was 12. I can now link this year's beginning cash to that same 12. So my beginning cash was 12. I add on 39.7 to give me ending cash in period 1 of 51.7. Great. Let's copy the cash flow statement to the right. And I've got ending cash of 51.7, 88.6, and 147.9. Let's take those figures, let's put them up into the balance sheet, and hopefully our balance sheet will balance. So right up to the top, cash in my balance sheet in E19 equals 51.7. Does my balance sheet balance? Yes, it does. Fantastic. Whew, I'm getting excited now. Guys, let's copy that into period 2 and period 3. Does the balance check go to 0? Yes, it does. Fantastic. So the cash flow statement was all finished. We then plugged cash into the balance sheet and the balance sheet is all finished.